Hello, everyone. Again, I want to thank you for your time for attending this training. For today's video, we're going to discuss how to use or utilize the EFA. So without further ado, let's get started. So when you head over to EFA, you click that tab, and we always recommend using the full version. For compliance purposes, this helps out in creating that holistic approach for your client instead of using the light version. So let's head over and use the full version. And let's have an example here. So the first thing you need to do is to enter the name of the client. So we're going to use Jane Doe, for example, female. Let's make her birthday 1990, just for the example, January 1st. Perfect. Jane Doe at gmail.com. So the first part is straightforward. You just type in all the necessary information. Then type in the address, 1234. Go. Vancouver, Canada, British Columbia. U5X 4K3. There we go. And if there is a spouse, you go add it as well. So in this example, we're going to add a spouse just so you can see the full picture, if ever. So add a spouse, John Doe. It's a male. Let's put them to 1990 as well. January 1st. Perfect. And if they have a child, you add it as well. So you hit save. So always hit save at the top right or the bottom right so that it's saved no matter what. And then you hit next. Now, in this portion, we always check include both incomes to calculation, just so we get to see the differences between the husband and the wife. So for the first parts here, which are the retirement age and life expectancy, don't change it. Leave it as it is. Just use computer estimate. The one you need to change here is the current monthly income. So for Jane, let's say she's earning 5,000 net income. So net income is the take-home pay, whatever goes to their bank account. For the monthly gross, let's just say this is her before tax income. And let's just give it an evenly match. Let's assume that John earns the same amount. For the monthly retirement income goal, this is very important. You're going to ask the client, out of the monthly income that they earn, how much percentage would ideally they would like to have when they retire? Because this portion actually determines two things. Number one, it determines the income that they want to achieve by the time they retire. But second, this also determines the income replacement or the future income that they want to protect if they were to pass away unexpectedly. Okay. For this part, we usually hover around 50% to 100%. You ask the client how much of the income they would like to expect when they retire and the future income they would like to protect. That's the question you should ask. And if they say, oh, you know what? I want to protect 100% of my income. There we go. Same thing with John. There we go. What it does is once you type in the percentage, it automatically shows the monthly income goal here. Okay, so you don't have to type this in. It automatically does it. So if you type in 50% here, look at the monthly income goal. Boom, it changed automatically. As for the rate of return, so ROR stands for rate of return. The default that we use here is 5% because we want to be conservative. It's 5%, 5%, and then 5%. This is the conservative assumption that we want to achieve for our client. But of course, the goal is to earn higher than that. As for the inflation rate, you don't change this. You leave the inflation rate as it should be. And then you would like to ask the client, would you like to put more money into your pocket now? If you're an employee, it's really easy. You may be able to increase your monthly take home pay by adjusting your withholdings. Do you want to see how that savings could impact your financial program? If you hit yes on this one, once you export the EFA, it will actually show how much is the total amount that they need to save every month in order to achieve the monthly goal that they want. Okay. If you hit no, then it is what it is. So you ask the client, but for the most part, the client would like to say yes. Because at the end of the day, the EFA is a free tool for your client in order to determine their needs. Okay. So once you hit that, you hit save as always, like I mentioned, wait for it to save, and then you hit next. The next part, it's going to ask the government pension benefits. In this case, we don't usually want to check this one because when you check this one, it actually predetermines the CPP that they would achieve, but this one is not that accurate. The main key reason why it's because not every client has started working here at age 19. Some are immigrants that came here when they were 30s, when they were 35, when they're 25, so on and so forth. And that's why just to keep things accurate, I uncheck this one. So don't check it unless the client has been born here ever since. Okay. Now you're going to ask the client, what type of employer pension do you have? Some of them know that they have a defined contribution. Some know that they have defined benefit. Some know that they have group RSP. If they're not too sure, don't worry about it. Just click no employer benefits for now. But if they do, then you just ask these questions. Okay. So no employer benefits for now. Now you're going to ask these questions. Is retiring well important enough that you would commit to setting aside money every month? Absolutely yes. Right? Like majority of us, we're working not because we want to work for life. The goal is to actually retire at some point and live comfortably. So we hit yes, and then you would ask them realistically, what age would you like to retire? At the end of the day, the definition of retirement is to not work anymore. Majority would say they would like to retire at age 65. Some would say they would like to do it at age 60. But let's keep it straightforward and let's choose 65. If I can help you retire at this age, would you implement that plan? Yes or no? It depends on the client, what they would say. Okay. Now, let's save this one. And if you would like to add a note, then add a note. Okay. I'll give you an example on when you should add a note, like the non-negotiable one. So let's hit next. And then now it's going to tackle about the investments that they have. So let's say Jane has a TFSA. For TFSA, we use the word emergency funds because at the end of the day, TFSA is liquid. So just an added trivia for everyone. There's liquid and non-liquid in investments. When it's liquid, it means that the money can easily be withdrawn with no hassle. Non-liquid takes a long time. Like there's long-term maturity, or sometimes if you withdraw it, there's like a taxable uh, situation that the client must face. So with emergency funds, TFSA, these ones are very liquid because they can easily withdraw it if need be. So for owner, let's choose Jane. Investment type is TFSA. Amount saved, let's say 5,000. Current return rate of return, you can ask them, Ms. Client, do you know your current rate of return? If they know what's up, they can see it in their statement. If they don't, just put 1% each. Because usually Some clients that are not too familiar with investing and just wants to save, the bank usually puts them in a traditional savings account, TFSA. That's the reason why the rate of return are not as high. Usually it's around 0.05% or 0.5%. But in this case, we'll just put one because that's the minimum that we could put. For investment frequency, you ask them, do you put in monthly? Do you put in biweekly? Oh, I put in biweekly. And then you type in, how much do you put biweekly? Oh, I put in $100. There you go. The monthly contribution is predetermined on this one, so you don't have to change this. All you have to do is this. Okay. If you do monthly, let's say they're putting in monthly, type in $200. There you go. All right. Now, let's add in another investment. Let's say the client, like John, for example, doesn't have any TFSA or RSP, and it's just in a traditional savings account. Then you type in emergency fund again because a standard savings account that's not in a TFSA could also be an emergency fund. Investment type, because it's a traditional savings account, you type in other, and then the amount saved, let's say John has 20,000. Rate of return, 1%, 1%. Investment frequency is monthly. Let's say he's putting in $400. Okay. If you want to add more, then do so. Just add investment. Otherwise, if this is it, then this is it. Now it shows here, if we could show you a better solution for these accounts, would you be willing to move them? This is now another opportunity to help your client grow their money. Through what? Through different types of investment accounts where they can transfer these money that they have right now through Beneva, through IA if you're contracted, Manulife, as well as Assumption Life. Okay. And the thing is, like, we're going to have other trainings on how to do those, but pretty much the goal here is to actually help the client make their money work hard for them, let their money grow higher than what it is right now. And with the Beneva, IA, Manulife, Assumption Life investment accounts, the management fees are much competitive and on par with a traditional mutual fund. But the good thing about it is that with Beneva or other partners' investment accounts, it still has those protection, like that benefit protection, um, so on and so forth. And you can also do beneficiary designation, which means it bypasses probate, so that the total amount of money doesn't have to be lower than what it was. Okay. So if we could show you a better solution for these accounts, would you be willing to move them? Well, let's go yes, right? Because at the end of the day, as an advisor, you're not just here to help them get a life insurance protection. You're also here to help them get uh, their investments to grow as well. Okay. And then let's hit save. And once you hit save, you hit next. Now remember in the first part where you can add Jane, you can add the spouse, which is John, and then you can add children as well. But in this example, we didn't add the children. But if you add the children in the first page, it will show up here automatically for their education needs. But what if you forgot? You're like, oh, they actually have kids. Don't worry because there's an add child button here. So you add child here, you type in their name, and then in this case, let's pretend they have kids. So let's say James is the name of their child. So date of birth is, let's say, 2016, February 1st. Years of education. This one is pertaining to the college education. Okay. So you're going to type in 4 years because usually that's the standard. Current amount saved is what's in their RESP. Okay. So their registered education savings plan. So let's say they put in 4,000 already. And then how much is the estimated annual cost? The default value we put here is around 15,000 to 20,000. Okay. Especially if they want to be a doctor, lawyer, so on and so forth. It does get expensive. So the goal of this education need is to protect the future tuition fee that their child would accumulate if they were to pass away unexpectedly. Okay. And then let's say they're putting in $100 per month. You put it in there. As for the inflation rate and rate of return, you don't change it. Anything that's pre-calculated here, you don't change it. Anything that's blank, that's what you will change. Okay. So that's what it should look like. But again, I just show this to you so that you get to see what it would look like if you add a child. But just to keep things simple, we're not going to add this. Okay. Because remember, when we did the first example earlier in the first page, it's just the husband and wife. So we're going to delete this item. And then since they don't have a child in this example, we're going to hit skip. Now, here's what I want you to do. The next tab you're going to come across is life insurance. So as you can see, whenever you hit next, you hit the personal information, savings for retirement, education needs, and then now life insurance. For now, I want you to temporarily skip this and move to the debts and mortgage. Because from what I notice for life insurance tab, it also asks about the debts and the mortgage. So might as well fill up the debts and mortgage tab first before heading over to life insurance. So how do we do that? We hit skip for now, temporarily, and let's head over to debts and mortgage. So let's say, so for the debts, here's the tricky part because there's different types of debts, right? Like credit card, car loan, bank loan, line of credit, and other. And specifically for credit card, you're going to ask your client, Mr. Client and Miss Client, for your credit card bills, do you get to pay it on time? If they say yes, then you don't have to put it here. The only credit card bill that you will put here are the ones where they can't keep up with the payments and they have to do a minimum payment. So for example, let's say they have let's say this one is BMO credit card. So the name of the bank and then credit card. And then the balance owing is like 10,000 and they only pay the minimum payment, then there you go. But let's say they put in $300. So they don't get to pay it on time, right? These are the types of credit card that you will put in. But let's say their credit card bill every month is around $1,000 and they get to pay it every time, like every month, then you don't have to put it. So in this case, we're not going to put in a credit card debt, just because in this example, we assume that the client, well, they mentioned in this example that they keep paying their credit card bills on time. So what should we put here? Let's put in a car loan. Let's pretend it's a Honda CRV and it's a car loan. Okay. Payment type is fixed. You ask them approximately the start of loan date. So let's say they started back in 2023, April 1st. The next payment date would be around the 17th. The interest rate, it should say in their statement. So let's say it's 4.25. And then let's say it's a 7-year term. Okay. It automatically determine months. The original amount, let's say the total loan amount is around 55,000. And then the fixed payment amount that they put in is around 758. So it automatically does that for you as long as the interest rate is accurate. Okay. Now, if let's say they're putting in more, like let's say they round it up to 800, then just put it in there. Okay. Now, let's say they have a mortgage as well. So add the mortgage and then just be like Surrey Home. And then let's say it's fixed. You ask them the current market value of their home. Let's say it's 1.1. And then the purchase price was around 1,050,000. And then the monthly property tax, let's say they'll be like, oh, we pay annually for the property tax. So if they say they pay 3,000 a year, then just divide it to 12, just so you can come up with the monthly property tax. So in this case, let's say it's 3,000 divided by 12, then that's 250. Now for condo fees, if it's a home, then you put in zero. But usually the other word for condo fees is the strata. So you ask them the strata fee and then you put it in here in the condo fees. For current balance, let's say their balance is still around 950. And then the next payment date is around the 30th. Mortgage renewal date, let's say it's 2 years from now. So you just go to 2028, April 1st. The interest rate, it should show in their statement, in their contract. Let's say it's 2.99. Go mortgage term in years. The mortgage term in years, as it says here, is the length of time, usually in years, which have the parameters of a mortgage have legal effect. After the expiration of the mortgage term, the remaining balance of the mortgage will need to be renewed. So in this case, right now, since they're going to be renewing in 2 years, the mortgage term is usually 5 years because they have to renew their term every 5 years, usually. Now the amortization period is like how many years in total will they be paying it? The average is around 20. It could be 25 and it could be as high as 30 years. So let's just say it's 25 years. Okay. Payment frequency is like, let's say they pay every month. You ask them, how much do you pay? And then they're going to be like, oh, we pay $3,000. There we go. And you're done. Now, let's hit save. So once you save it, then guess what? You're going to go back to life insurance because you already have the information for debts and mortgage. So you head over to life insurance, and here we go. So in this example, like I mentioned, since they don't have a kid, we're going to use the years for survivor income as a default for 10 years. Okay. Now, if they have a kid, it's usually around 15 or 20 years. So remember, write this down, everyone. If they don't have kids, put it as 10 years. If they have kids and the kids are still young, like 5 years old and below, put in 20. But if their kids are like, 6 years old and above, do 15. 15. Okay. Please take note of that. Okay. So again, let's go back. Let's make it 10 years. And then as for the funeral and final expenses, you will ask them. There's a default that we use. We put in 30,000 if they want cremation. And we do 50,000 if they want to do the standard coffin. Okay. So let's say they want to be cremated, 30,000. Just put in 30,000 here. Now, is there an expected annual rate of return on after-tax life insurance invested? We're going to put in no here. Do you want to include children's life insurance plan? No. Now, in this case, would you like to include John's debts in the life insurance calculation? Yes. No, because they don't have it. The only thing they have, well, if they want to include the car loan as well, then there you go. Otherwise, if they don't want to, then hit no. But in this example, let's say we hit yes. Now, you see how it shows debt already? That's the reason why it's best to skip life insurance first and then head over to debts and mortgage, just so you have this information over here. Now, would you like to include Jane's debts? Yes, just in case, if they want to protect the Honda CRV as well. Would you like to include Jane's mortgage in the life insurance calculation? Now, this is tricky. So, in this case, we always put yes. Okay, we hit yes. for both. And then you're going to ask them, do they have a mortgage life insurance already in place? For the most part, majority of them don't have it. And that's the reason why you're going to add it into calculation as well. So no. Otherwise, if they have it, then you hit yes. Okay. And then you're going to ask them. So in this case, this is a bit, I would say this is a glitch. It says enter the amount they pay monthly for their monthly coverage, but no, please enter the coverage amount for it. So the thing that you're going to be putting here is not the monthly payment that they pay if they have a mortgage life insurance, but rather you put in the total amount that they have. So in this case, let's say it's 1050, you put in 1050. If it's 950, whatever the value of their house when they purchase it, that's what you're going to put in. Okay. But in this example, we're going to put no. They don't have mortgage life insurance, so that we can add it into their total needs analysis. Now, would you like to include Jane's expenses for the children's post-secondary? Earlier, I just showed you an example of the education if you were to add one. But then again, as I mentioned in this example, they don't have any kids, so we're going to put no. Same thing with John, education, no. Now, does Jane currently have any life insurance? If they do, put it. Okay. Now, what type could they put in? Personal insurance, group insurance, disability, and critical illness. If they only have the group insurance, it doesn't really um, minus that total amount in the total needs. That's the reason why, just to keep things simple for everyone and not confusing, if they have a work life insurance, it doesn't count. It has to be a personal insurance. So if they do have it, then check it. Now let's pretend they do have it. Let's say Jane has 250,000, and what she's paying is $50 a month. John has 250,000 as well, and let's say it's $50 per month. Will you be replacing the current coverage? It's self-explanatory. It's up to you if you want to replace it. Make sure you have the life insurance replacement declaration form in order to stay compliant. Otherwise, if you're not replacing it, amazing. Because at the end of the day, the goal here is to not replace a client's plan, but to enhance it. The only way or the only reason where you were to replace a client's coverage if it doesn't meet their current needs right now, or if there's a much better option where they will pay a lower amount for what you're replacing and it's giving more value. All right. Now, has Jane ever been diagnosed with a serious health condition? In this case, let's pretend they're healthy. So you just put it no. Otherwise, if they have been diagnosed with a serious health condition, then you hit yes. Jane, does Jane smoke? No. Then no. Then here you go. You're going to ask this information to them. Would you say that it's important to protect and secure your family's future? It's a self-explanatory question. Let's just fill this up where you're going to ask these questions to the client, and let's say it's predetermined already. There we go. More protection. For this portion, like when was the last time you spoke with the agent who sold you the insurance policy? And then optional. These two, you don't have to fill it up. Just move over to the next one and then downwards. Do you want your debt to be paid off? Yes. Do you want mortgage to be paid off? Yes. Children's education paid off? In this case, no, because they don't have a kid. If you're to die prematurely, do you want your own family expenses? Yes. Now, if all these were paid off, how much monthly income would your survivors need? In this case, this is a very simple answer. Remember earlier the income that they want to protect, the retirement income goal? So in this example, we put in that they need 100% of the income. So in this case, you just put in that exact income and the years, which in this case, because they don't have any kids, we're going to put in 10 years of income. Okay. That's how easy you could put the numbers here. All right. Just to keep things simple for everyone. If they have protection, which they do, if we put together a plan that improves your current plan, would you change it if it were better? Yes or no? Self-explanatory. If they don't have any protection, then you don't have to fill this up. So in this case, they do have it. Let's say they said yes. Boom. Are you interested in disability, health, or critical illness insurance coverage? You type in critical illness coverage. And again, remember, I mentioned you need to put in a note particularly in one tab, and this is the one. What is it? It's the life insurance tab. So you add a note, make sure it's relevant to both, and this is where you will paste the cover letter. The cover letter summarizes all the analysis that you have done for the client, and this one covers your back in case an audit happens and you stay compliant. So speaking of cover letter, there's going to be a specific training for that. And that's the video that you're going to be watching next after EFA. So sit back, relax, and enjoy because I'm going to discuss the cover letter uh, portion. And in our team, in our system, we have a cover letter prompt that can make things easier for you and you don't have to think as much. So keep an eye on that specific training for cover letter. For now, let's delete this because you're going to know how to add it. We're going to close this for now. Hit OK. And then let's make sure we hit save. Once we hit save, you hit next. And once you hit next, it's going to go back to the debts and mortgage, as you will see shortly. Since you pre-filled this already, we're going to hit next again. And the thing that you have to fill up is the financial situation. As we can see, both of their monthly net income are here. And the financial situation tab shows all the expenses that they have and the disposable balance that they do have, which us as an advisor can help curate or allocate properly to reach each of their financial needs. Okay. So as we can see, there's mortgage payments here. They're not paying rent, property taxes. So anything that you pre-filled on the life insurance tab or any other else, it will be shown here. Now you're gonna ask them, how much do you pay for hydro? Let's say every month they pay $100 for their phones together. Let's say they pay 150 for their internet. Let's say they pay $70 a month for their groceries. All the things that you're gonna be putting here doesn't have to be super accurate, but it needs to be, as approximate as possible, like an average type of thing, just so we can benchmark the approximate disposable balance that they have. So for groceries, let's say they spend $500 a month as a couple. For the life and health, you leave this blank for now. For transportation or car, they have car loan payment. For licensing and registration, I'll leave it blank unless a specific province makes you pay the licensing and registration every month. But for the most part, people pay car insurance every month. Let's pretend their car insurance is $200 a month. Their gas, let's say they spend $300 per month for car wash repairs. So straightforward stuff. You're just going to ask them, how much do you spend on these ones? If they don't, leave it blank. For credit card payments, you don't worry about this portion because at the end of the day, the thing that we're going to try to determine are all the expenses that they have, not the credit card payments, because it kind of ruins the calculation if you because for example, like the groceries, they might be using credit cards to pay that, and that's why it's a bit redundant if you're going to put in how much do they put in under credit card payments, since we've already put in the groceries portion. Okay. Now, as for TFSA, it shows here what they put in, so on and so forth. They don't have children. Let's say they take out once a month, 150. If they have gym memberships, put it in, so on and so forth. But let's determine this is it. As we can see here, they have total spendings of 5,804, 870. And they have disposable balance of 4,130. Okay. This is your current disposable income, which you can use for a multitude of things. So let's turn it into a meaningful income and direct it towards your goals and dreams. So you save this one. And upon saving, you hit next. So we're getting closer to the EFA. For your first few EFAs, it might take you approximately 30 minutes or so. But the more you do it, you're gonna master it. You can probably finish it in 15 minutes. So this is you, right? So if you would like to put some extra goals and dreams, then you add it here. So when you add it, let's say they wanna, you know, buy a property, a second property. Let's say the cost of the current goal cost is 500,000. Current amount saved is $0 because they haven't started yet, right? But let's say they want to put in, I don't know, $300 a month for that, and the desired monthly contribution, you put in for $300 as well. Let's say they want to achieve it 10 years from now. And then the rate of return, of course, let's keep it simple, conservative, 5%. And this one is for second property. And then you hit save. Otherwise, for the most part, if they don't have any goals and dreams yet, you just skip this. Okay. So if they don't have any goals and dreams, I repeat, just skip it. Now, the final one is net worth. It shows all the assets that they have as well as liabilities. Okay. So once you've done it, you hit save one last time and you're done. So this is the EFA, ladies and gentlemen. So again, before you finish this, you need to do one last thing. Like I told you, the life insurance tab, if you go here, you need to make sure you add the cover letter over here. And you will consider yourself finished, which again, I will have a separate training session so that everyone can do it properly. So let's assume that the cover letter is done. Okay, you hit save, so on and so forth. Let's say you move to network and you're done. In order to export the PDF, you need to hit PDF and then you do export all. Once you do export all, I'm going to quickly share the PDF. There you go. It looks like this. Prepared for Jane Doe and John Doe. So it's all the information are here. That's the good thing about the EFA. It actually creates a holistic view for your client. As we can see here, analysis for Jane. This is her shortfall, which already take into consideration her personal life insurance. So she is actually underinsured by 1.4 million. Okay. And it actually shows the different types of criteria of the needs that she needs to protect. Same thing with John. It will show here. There you go. It also shows their debts and mortgage. And it actually shows a snowball amount or the things that they need to do in order to make sure that they pay it off in time. So it actually gives a really nice representation of the things that they need to achieve in order to have a really good life. So as we can see here, to achieve your retirement goal at age 65, you will need $13,000 a month due to inflation. If you follow a current plan by retirement age, you will have 275,000. So right now, as we can see, remember the savings account that they have, the 25,000 in total. This is the TFSA as well as the savings account. If they put in $600 monthly extra by the time they retire, they will achieve 275,000. And remember, their shortfall, or I mean their disposable balance, shows around 4,000-ish. So they have more money to play to put more money towards their retirement. Isn't that amazing for the EFA? It actually gives you an idea for your client in order to achieve the retirement that they would like to have. So I'm not going to go over in here as much, but I want you to see it for yourself. And if you have any other questions regarding this one, then speak with your upline. Okay. But of course, if you're not too familiar or you forgot what to do in the EFA, don't hesitate to watch this video again. What I'm going to do is for the YouTube video, I'm going to create timestamps so you can just forward specifically on a tab that you're not familiar with so that you can easily find it. All right. So pretty much that's everything for the EFA session. And I hope you have a wonderful day. Let's continue to help clients and let's grow together. Thank you.